Hey traders, Raghee here. Welcome to Charts and Coffee for Friday. All right, so kicking off this August 20th trading session. It's not been a dull week. I think both the bulls and bears feel somewhat justified for their sentiment, for their trades, and August should not be boring. I mean, we definitely have a group of folks who feel the Federal Reserve is still going to support this equities market. There's a group of folks who are looking at seasonals and other factors. And so for me, I'm asking myself a question. Has this market overreached? Is it overextended? For me, is it parabolic? Have we extended in such a way where this market's up on its tippy toes or not? It's easy to lose your balance up there. That's going to be really the topic of most of what I'll be looking at when I'm with you all in the futures and options room today for the close. So as we wind down the day, 3 p.m. Eastern, I'll see you all in both those rooms. We're going to dive a little deeper into how do I measure what a parabolic market is? How can we consistently, unemotionally, in a process-driven way, put a measuring stick to the market using historical volatility as the way in which we understand what overextended is. And then we'll get into pullbacks, reversals versus retracements, things of that nature, because, one trader's crash is another trader's buying opportunity. For one trader, there's a crash, and for the other trader, there's a retracement and a pullback and something they will buy into. So the whole question now becomes, in this post-June 16 environment where the Federal Reserve tweaked the message and has been following up on that, we are going to taper. We're not really sure how much, but it's going to be glacially paced. And, we're tracking towards, we're mapping towards eventual rate hikes. Can the equity markets, deal with that? That's really where we're at. So there's a group of folks who think that bounces should be confirmation of further upside. All my cards on the table, I'm part of that group. And then there's folks who think that bounces, rips higher, should be sold into. So we're kind of now in probably the first time in a long time in the whole, do we buy the dip or sell the rip? Now, here's the thing. The answer to that is going to be based on your analysis. There's no right or wrong, because right or wrong means somebody knows where the markets are going to be tomorrow or next week. Newsflash, nobody knows. So let's go with probability. And I think we're more so this year, and it's been this way all through 2021, better off with understanding relative outperformance. This is not the high tide lifts all boats market. Even though I do have my bull shirt on today, this is not the high tide lifts all markets. There are certain corners of this market at a sector level that are going to outperform. All right. So, and of course, when you're relying on your tools for those answers, you've got to ask yourself, are my tools predominantly trend following? Are my tools predominantly an oscillating tool? Because your limitation to analysis comes from your tools, comes from your process. Limitations aren't bad, but remember, if you're looking at an oscillator to determine overbought, oversold, remember, that's all an oscillator does. And in a trend, everything looks overbought in an uptrend, for example. And if you're only using trending tools, every dip looks like potentially a viable opportunity. That being said, over the next couple of weeks in the countdowntrader.com, my blog / newsletter, whatever you want to call it, my resource for all the different things that I'm looking at in the market, we'll be talking about my indicator bundle, what they measure, why I look at 3 specific groups, types of indicators: volume-based, price-based, and trend identifying. So we'll definitely be diving more into that. All right, let's take your questions. All right, great to see you all here. Fantastic. All right, kicking it off. Hey there, Dan. Good morning. Good morning. I took your day trading class at the end of June. Thank you. It's been a game changer. I mean, my pleasure and my job. That's so awesome. I can't thank you enough. We've had a pullback in XLF. What are my thoughts? Love where your head's at, Dan. So XLF, much like DIA and a few other sectors that I talked about in some free videos last week, I believe it was. Yeah, last week. The participation conversation that we had last week. The XLF has just now sort of join the party. And in some ways, some folks might say this is rotation. I don't actually believe it's rotation, because rotation means while something else is heading lower, something else is benefiting from the inflow. I think we're seeing more money coming off the sidelines. Whether that's good or bad, that's a whole other conversation. But is this buyable? So the drop that we've had here, and Dan, it is a Friday. I would like to see maybe another inside day, maybe a minor low. I don't want to engage XLF any sooner than 37.30 because it's a fresh uptrend. It's more vulnerable to volatility, and I'm better off waiting for the blue grab candle like we see here. Blue meaning a neutral grab standing for green, red, and blue. I'd rather wait for this neutral candle, just as you're seeing right now, for sure. So I like what you're looking at. I think there's a buying opportunity, but let's also keep this in mind. Let me do this here with you. So let's open up the XLF multi-chart. So this is where we look at all the heavily weighted stocks within the financials sector. And then the question is, as XLF is pulling back, is there a better relative outperformer at the stock level that we can look at? I'd say Wells Fargo is about even to the XLF, double green. So keep an eye on WFC, keep an eye on MS. That's actually a really nice relative outperformer, Morgan Stanley. SPGI, pricey but good. Pricey but good. So I would say, yes, we can go with the tide at the XLF level, or we could go with the individual boat at the Wells Fargo, Morgan, even the SPGI level. Although SPGI is leaving, unless it comes back down again, I can't really do anything with SPGI, but what a beautiful pullback in a double green. I mean, really established double green. So I do like those four names. And then, like you mentioned, the boats of Wells Fargo, Morgan, and SPGI look great. XLF would be a great way to play all the boats, but keep in mind, you're also playing boats that are not necessarily great relative outperformers. You are, really still lumped in with some underperformers, like right now, American Express, which was great, and then now it's not. So there are a couple names, Citi, meh. So remember, the tide is still going to be influenced by some of these less high-performing boats, if you will. So thanks for the question. Let's see. Hey there, John. John asks, which of my courses offer all your available tools, including HPMR? John, none. HPMR is a tool. So thank you for the question, and that there's oftentimes some confusion. My HPMR tool, I make available all the different packs that I run on my screen personally in the Sector Secrets Mastery. They have to be run on a regular basis. So maybe in 2022, and we've been toying with this idea now, 18, 19, 20, 20, for almost 4 years. How do I make this process, my HPMRs, available to you guys? And, at some point we'll come up with a way, but for now, I keep the futures version in the futures room, and all the remaining packs, futures, currencies, some stocks, ETFs, are in my mastery. I gave, with the day trading class, that pack that lasted us about 6 weeks because they have to be updated based on volatility. Much like, for example, the Voodoo Lions have to periodically be updated, same thing goes with my HPMR, hourly price movement range tool. So because it has to be updated regularly, it's not part of any of the packs, but it is part of my mastery. So thank you for the question, John. I really appreciate it. And by the way, if you took the day trading class, anyone out there, the HPMR version that's there now is a little bit dated, but it's not that different yet than the fresh version that I ran on the 9th of August, was it? Yeah, I think the 9th. So if you're still using that older version, it's actually doing okay. I've tweaked it since, but if you want to use that older version, you'd probably be fine. So thank you for that. All right, next up is what gives me confidence that okay, Larry, thank you for the question. So you checked out the free video yesterday at the Simpler Trading YouTube channel. And thank you for the question. So What makes me think it's going to, bear with me here. I moved my screen. There we go. All right, what makes me think it's going to reverse? Well, I wouldn't necessarily call it a reversal, although, I can appreciate where you're coming from. So let's squeeze in a little bit more data and let's reset this chart. This is the Russell. Uptrend, 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 and chopping since basically March, definitely since the end of March. Back and forth, back and forth, back and forth. Couple things to note about the Russell. The fact that we're down here near the lows of my V-score. So for those of you that are not familiar with my V-score, it's part of the bundle, by the way. That is a study of standard deviation on the volume weighted average price. And so it shows me, not necessarily focused on the mean, but it shows me what the operating temperature of highs and lows, what the range has been, what the likelihood for support and resistance is, not using price, because I can do that with the Darvis. This is a giant Darvis pattern. Yep, those two purple lines, that's a giant Darvis pattern that we've been in since, as you can see, spring. So I'm at the support levels. And by the way, check out last time we were here. See that low right here? Let me use this here. See that low right there? Here we are, right back there. So V-score, volume prioritized indicator, says we're at support. We're still above the 200 period exponential moving average. And I believe that is, if I think of the 200 as the equator, which it really is in many ways, there's a large group of market participants that believe when we are north of the 200, simple or exponential, that's sort of the bullish territory or bullish hemisphere, if you will, of the market. We're in the bullish hemisphere. And as long as we remain above the 200, there will be a broader group of market participants thinking that this is a viable market than not, right? So we're just whittling down the probabilities of the path of least resistance. This is not a trend, but Charles Dow, 140-year-old time-tested theory, would tell us, I paraphrase basically, stick with the trend that was, respect the trend that was. We don't have a trend now, but what preceded the chop was an uptrend. So all that being said, I've got a lot of directional bias, and we're sitting at the oversold part of the market, which, by the way, we've bounced off of 4 times previous. So if someone told you this has happened 4 times, not that it's any guarantee that it's going to happen a 5th, but I'm not going to say, well, it's clearly going to break down. There might be a catalyst come September, October. Maybe the Federal Reserve fumbles the messaging around taper. Maybe there's some sort of geopolitical, maybe there's some sort of pandemic related, something that the market has not already had to deal with. This market through summer has had to digest a lot. It's been a veritable buffet of ridiculousness that this market has already overcome and remained pretty strong, regardless of pullbacks. So think about what really has to rattle this market. We don't always need an obvious catalyst, but most of the time, significant pullbacks, retracements, reversals even, they're going to come on some kind of news. They're going to be based on sentiment and psychology shifting, because we are now having to discount, digest, factor, bake into the cake something new that we had not before. So I'm going to buy not the dip. I'm going to buy this trough. I'm going to buy this test of the oversold zone. How do I recognize the oversold zone? Look, there's plenty of ways to do it, but what you'll see I've done, I've got my directional bias. We went through that process. Got the Darvis support right there, and I've got my V-score. So I've got a price-based tool, two price-based tools. One's crunching the closes with an exponential calculation. One's using a pattern to identify automatically where support is, and the other is saying, yeah, on a volume basis, we're sitting at an area where we're likely to bounce. And by the way, actually, everything on this screen is part of the bundle. So if you're curious, all right, Rod, so can I make my charts look like yours? That's that bundle, which, by the way, we have 2 sessions of live trading. So 2 separate days in the calendar, 2 sessions where I'll be walking you through intraday and intraday use of this. So thank you for the question. And that's why I think it's going to reverse. It's oversold, but I hope that little bit of deep dive shows you how I like to trade choppy markets, because this is a choppy market. Unlike the S&P, unlike the NASDAQ, this is a chop. So thank you, Larry. Terrific question. Good morning. Good morning. Next up, scanning the financials, a couple of cap market names come up. Yeah, so if you have a relative outperformer that is not necessarily a high concentration weighted stock, you have the ability perhaps to take advantage of a move that could outperform the sector and the stocks heavily weighted in that sector, because the tide around that narrative, in this case financials, I think overall is up. And then you are looking at a stock that isn't quite as tethered to financials. So if financials, XLF rolls over, or some of the high concentration weighted stocks in XLF roll over, what is going to be more resilient? What is going to have the ability to say, yeah, I can see what's happening over there, but my connection by way of weighting in this passive investing ETF dominated universe that we're in now is not, that connection is not as strong. So there's no harm in going down the list further to lower weighted stocks, but part of that same narrative, because they are going to have a certain, I'll say, healthy disconnect oftentimes that we might prefer. I'll usually do that when a market's chopping. I wouldn't call XLF an awesome trend, but I frankly, I wouldn't short it either. So yeah, I have no problem with doing that. If you want to go further down the list or find maybe names within the KRE, because KRE doesn't look as good as XLF. Regional banks are not faring as well as the financial sector. Just be careful you're not wandering into regionals too far. Make sure you're not wandering into KRE names as opposed to what I prefer, which is the emphasis on XLF names. So thank you for the question. Would I mind taking a look at DKNG? No, not at all. Let's take a look. Not trending. I think that's number one. And I am having a great morning. Thank you so much, Garrison. I appreciate that. Okay, I would treat this kind of like I would treat the Russell. The structure around the 200 is tricky at best. We had an uptrend, but then we also had a downtrend. This one's tough. DraftKings is tough. I would say you probably want to be fairly neutral about the top of the range and the bottom of the range. I would say the top of your range is going to be around $54.50 to $57. You're going to want to short that area, or you're going to want to buy the lower area. And if you can confirm that with a V-score. Look, right now the V-score is saying we're banging our head up against the mean. See how every time we try to get above it, stopped. So the closer we get to the zero of the V-score, there's a higher and higher likelihood that selling pressure is coming in. We are in, say, the upper half of the range, which is more a fatigue resistance zone. If you recall, I did a breakdown of choppy market zones by looking at the chop, cutting it in half, and then cutting each half in half. So you basically have quarters. And some of your best zones for fades within a yellow chop, which this is in, within yellow chop, is the top quarter and the bottom quarter. You short the top quarter of the range, you buy the bottom quarter of the range. That's probably what you'd end up looking at here, because it's not a trend follow. And even more difficult is the fact that we have a brief uptrend, but most recently a brief downtrend. So yeah, there's a chance that there's a slight preference to the short side for me in this case, especially as long as we're below the mean of my V-score. So thank you for the question. All right. Let's see there. Hey there, Lisa. Just joined sector. And hey, looking forward to seeing you there. I'll be in the chat, typing, looking at markets with you all this morning. I'll be hanging out with y'all a little bit. I'm in the room 5 days a week, essentially. But I'm on the mic every Wednesday for our Q&A in live trading. So, but Lorna and I are always around And we're super active in that room. I'm here trading all day, so why not hang out with a group of folks that are looking at the market with my tools, using my watch list. It just ends up being this great big think tank, and that's the way we look at it. So great to have you join our sector team. Love it. All right. Lorna gets the credit. Look, Seamus, I will tell you that Lorna and Trish, most of you don't know Trish. If Lorna's behind the scenes, Trish is even further behind the scenes. So, I definitely get a lot of the disproportionate credit, but it does not happen alone. We have the entire mothership in Austin. We have a huge crew of folks there, making sure all the wheels are turning, making sure all the gears are turning. And then, in the rooms, absolutely. And you're so right. I appreciate that. I'm sure they do too. I was curious about how I picked my stop loss for Natty Gas. Sure. Let's jump on over there. So when it comes to natural gas, a couple things. I know that the 55 exponential has been in play. Oh my gosh, it's past 9:20. I have been completely off my game when it comes to observing the clock this week. My apologies. I should probably let you guys go, but let me answer the question, because this goes far beyond Natty Gas. We know that the 55 exponential on deeper pullbacks has been in play. Of course, I've got my wave here, right? I don't have any red grab candles, do I? I don't really even have a red upper row on the JT Multi, which, by the way, is included in the Workspace bundle. We have it for TradingView, TradeStation, and Thinkorswim. And a lot of you know, especially if you're in the mastery, I've been spending a lot more time in TradingView as well as TOS, but I've been spending a lot of time in TradingView. Love the platform. That's what we're looking at right now. So I never got even a red upper sentiment and momentum shift in the JT Multi, clearly on a downtrend. No red grab candles. I mean, we color code everything. This is you remember the PATE by numbers? Right? There's a number 1, a number 7. This is kind of the trade by numbers, right? Where are the colors telling us our directional bias and expectations need to be? I'm still very bullish. No red grab, no breach of the 55, no real breach of the wave, no shift in the JT Multi. And then, of course, we have our percentage of premium paid threshold that I use, and that has kept me in the long side on Natty Gas. Now, I will tell you, Natty Gas has been working great. Natty Gas is actually going to be a really nice trade on the open. But hey, I don't like when people talk about wins and don't talk about losses. Crude oil did not do what I wanted it to do. It's sitting in an area which could be supported, but it did not stop where I thought it was going to stop. So let's talk about taking a paper cut. That's what I call them. It's okay to take paper cuts. Just don't lose a finger, right? It's a quick paper cut. Get in. Didn't do what I wanted. Threshold for premium risk, behind us. We just get out unemotionally. Small losses are easier to take than big ones. It doesn't mean that we can't get back in at some point, but also recall that if you're looking at structure, Natty Gas was better structure than crude, because one's trending, one's not. So here's an example of where the wheels fell off the wagon. Got a bunch of places where things are looking great. Looking forward to Pepsi this morning on the open for sure. Dropbox was good to us this week. Bonds, we're going to tag 166. We're looking at another profit target to the upside in bonds. So some things are working, but I love talking about losses, because this is where we really differentiate the good from the great traders. And great traders recognize when validity is behind them, risk thresholds are behind them, and just say, okay, I'm out. So anyways, thank you so much. Let me wind it down here. Sorry for going over, but I really appreciate it. And I will see you all on Monday for our next episode of Charts and Coffee. And I will see you all in the Simpler Options and Simpler Futures room for the close. And we will do an even deeper dive into these topics. So if you're not a member of our Simpler community, one of our many masteries or rooms, do check out a trial. You can kick the tires with us. Check out what we have to offer. Meet a lot of our traders. And, looking forward to seeing you there. Let me know when I see you this afternoon, if this is your first week or even first day. We'd love to lock arms with you. The seasoned members say, hey, we've got someone to kind of, bring along here and help out. So we've got an amazing community. All right, gang, have a great one. Have a wonderful weekend. and I will talk with you all on Monday. Be good to each other.